Before we start the video, I'd just like to introduce our new revision package. For $10, you get 7 days access to our entire ACCA Performance Management exam course. For more details, please check out the links in the description below. And now, on to our video.
Hello everyone, and how are you all doing today? So today we're going to be doing yet another past paper question for the ACCA Performance Management exam. And the question we're doing today is from the December 2018 past paper. It's a section C question number 32, and it's about material variances, basically material usage, material mix, material yield variances, that sort of question. Okay, so again, this is a very common topic tested in section C in the performance management exam, which is why I picked this question. And I think we should get straight into it. So without any further ado, let's get into the question. As always, we're going to be starting by reading the requirement. Okay, so the requirement says, Part A, calculate the following variances for the last month. For 4 marks, we have the material usage variance for each ingredient and in total. So we need to do it separately for each ingredient and in total, and the total material mix variance and the total material yield variance, and collectively all of this is for 11 marks. And then part B is 9 marks for analysis. Okay, and that's a typical variance question. You'll have half the marks approximately for the calculation and half the marks for analysis. The issue is that students become overly focused on the calculation and ignore the analysis, even though the easier marks and the quicker marks are going to be from the analysis itself. Okay, now the calculation here, it's not for the price, mix and yield variances, it's for the usage variance, which then splits up into the mix and yield variances. Okay, so we'll do the usage variance calculation using the formulas we covered in our videos, and then we'll do the mix and yield variance calculation collectively using the table that we covered in our videos. Okay, so let's go through the question. It says, Kappa Co. produces omega, an animal feed made by mixing and heating 3 ingredients, alpha, beta, and gamma. The company uses a standard costing system to monitor its costs. The standard material cost for 100 kg of omega, okay, is as follows. So we put in around 120 kg of the ingredients, and this is the cost, about $400. Note the mixing and heating process is subject to standard evaporation process. Their agricultural products and their quality price vary significantly from year to year and are set based on that. Okay, so all of this data is probably for analysis. We don't need to worry too much about it for the calculation. This is what's relevant. So we had the standard information above, as we would with most variance questions, and we'll have the actual information separately, like over here. So last month, 4,600 kg of omega was produced using the following inputs. Okay, so that's interesting. Usually they talk to us about things in terms of inputs, units. The finished goods are usually produced in terms of units. Here the finished goods for units for omega are actually in terms of kg, and 1 unit technically is 100 kg of omega. So if we have 4,600 kg of omega produced, that's effectively 46 units of omega, right, for our actual number of units in case we need that in the variance calculation. Okay, and then we have our actual numbers, and it says at the end of each month a production manager receives a standard cost operating statement from Kappa Co's performance manager, and it includes all the all of this is probably before the analysis, so we can leave it for now. Okay, so as always, we'll start by labeling the question, the part that we're attempting. We'll make it bold to distinguish it from the rest of the answer and keep it in a separate column. Okay, so we're going to be calculating the material usage variance first. Let's start by just putting the formula down for the material usage variance, and let's also put the shorthands we'll be using. So MUV will be using for material usage variance, so we'll put that shorthand down. Okay, we'll be using S, let's say S for standard. We'll be using A for actual, so this is also addressing the mix and yield variance shorthands as well. Q will be for quantity, P will be for price, M will be for mix. Okay, now what was the formula for material usage variance? Material usage variance is equal to, you have your standard usage, so standard So U for usage minus, so let's put that down since we have usage as well. U for usage minus the actual usage into the standard cost in per kilogram, right? Okay, so C is cost, and let's just write that down fully. Standard cost per kg. Okay, material usage variance for the alpha is equal to, okay, and then we'll put our numbers in. So standard usage is always calculated by taking the actual number of units into the standard kgs per unit. So like we said, 4,600 kgs produced and 100 kgs per unit means there's effectively 46 units being produced, and each unit of alpha will have a standard usage of 40 kg. So this will become 46 into 40 minus the actual usage of alpha, which we'll take from below, which is 2,200. Again, be careful, material usage variance, we're looking at things in terms of kgs, not in terms of dollars. The final answer will be in terms of dollars. So 2,200 into the standard cost per kg. The standard cost per kg we'll take from up here, which is $2, right? So into 2, okay? Oops, I forgot the equal sign first. So for alpha, it's going to be 720 adverse, okay? And now we can copy this down below. So after alpha, we have beta. You can keep this all collectively. I figured let's just put that all in one cell rather than showing collectively, okay? Again, how you format the answer is totally up to you. This is just one of the ways you can do it. Okay, so for beta, again, 46, this time into 60 kgs per unit minus the actual usage, which is going to be 2,500. We should be putting all of this in brackets, so let's just put those here, into the standard cost per kg, which for beta is $5. Okay, so $5, we get 1,300 favorable. And finally for alpha, sorry, not alpha, there's a typo here, this should be for gamma. For gamma, we'll be putting is equal to, again, 46 into your 20 kgs per unit minus the actual usage of 920 into the standard cost per kg of $1. So 1, we get 0. Okay, so no material usage variance for gamma, and the material usage variance total is equal to, just add all of these up, 580 favorable. So our mix and our yield variances should add up to 580 favorable. Okay, let's just mention the fact that the positive variances are favorable and the negative are adverse, though that's pretty apparent, but just to be on the safe side, right? So positive variances are favorable and negative variances are adverse. Okay, so we have our material usage variances covered, and this is the first part of part A, so let's just label that so that the examiner can follow. And then we have the yield and mix variances. Since those parts are going to be calculated collectively, let's just mention that fact. So 2 and 3, this calculation is going to be collectively performed. Okay, so remember our table format. We'll have the 3 ingredients. We have alpha, beta, and gamma. And since we're only doing the mix and yield variance calculation, it's going to be based on the last 3 columns of our 4-column table. So the second column of our table had the format actual quantity as per the actual mix and standard price, right? Then we had the third column, which was actual quantity as per the standard mix and the standard price, and the last column, which was the standard quantity as per the standard mix and the standard price. Okay, so let's fill out the table, and let's just format the heading a bit so that it's clear that this is the heading. Okay, and let's make this bold as well. Okay, so the actual quantity as per the actual mix, this we take directly from the question, which will be these numbers: 2,200, 2,500, 920, right? Okay, so 2,200, 2,500, and 920. Okay, and for the standard price, we'll again take that from the standard cost card, which are these costs. Remember, standard price is the cost per kg, because we're dealing with kgs here. We will multiply them by the dollars per kg, not by the dollars per unit, which students sometimes do. So it's not 80, 320, it's 2, 5, and 1. Okay, so we'll take this multiplied by 2, take this multiplied by 5, and take this multiplied by 1. Okay, and we'll take the total here, and we'll take the total here. Okay, let's make these bold. Okay, so we have our first total, which is the 17,820. Now we need the actual quantity if it was split as per the standard mix. So we put in 5,620 kgs of ingredients. If we had followed the proportions of the standard mix, how much would have we put in for each ingredient? That's what we're trying to find out. So we're dealing with the standard mix, and we will take the standard mix from the question itself. So we have the 3 ingredients: alpha, beta, and gamma. So in the standard mix, we'll put in 40 kg of alpha, 60 kg of beta, and 20 kg of gamma for a collective 120 kg, right? And that means the proportions are that we'll be putting in 33.33% for alpha, 50% of our ingredients as beta, and 20% of our ingredients, 16.67% of our ingredients as gamma. Okay, so what that means is that if we apply these percentages to the 5,620 kgs that we actually put in, and distributed those kgs as per the standard mix, 33.3% would go to alpha. After that, 50% would go to beta, and the remaining would go to gamma. And if we add these up, we'll still get the total 5,620. Okay, once again, we'll multiply these by the standard price. We'll just copy the formula and it'll do it for us. We'll get these amounts, add them up, we get our total 18,733.33. Okay, the last one, standard quantity as per the standard mix. Okay, so how will we get this? Again, it's the same as the standard usage we calculated in the material usage variance, right? So we'll take the 46 into 40, the 46 into 60, and the 46 into 20 we did up there. Okay, so students often get confused, but if you already calculated the material usage variance, technically you've already got the standard quantity as per the standard mix. Okay, so this is 46 into 40. Let's link it down to the formula below so that it's all tied in together. 46 into 60 and 46 into 20. Technically I could have just copy pasted the first one, but okay. And once again, into the standard prices, we'll just copy paste these amounts. We get this, add this up, we get this. Okay, and we have the mix variance and the yield variance. So the mix variance is the total for the third column less the total for the, in this case, the total for the second column less the total for the first column, and the yield variance is the total for the last column less the total for the second last column, right? So we get these two amounts, and if we total them up just to tally them with our material usage variance, we should get the same 580 that we got up there for material usage variance. Okay, so we know our calculation is correct, right? So the calculation, as you saw, is quite straightforward. The more you practice, the more quick you'll be able to do it. And like I've said over and over again, the reason we're doing so many practice questions for these tables like mix yield, mix quantity variances, so that you guys get a hang of it. Once you get a hang of it, you'll be able to do it quickly, and as you can see, all of this calculation was for a total of 11 marks. But mind you, if this calculation comes in the multiple choice section, you could be expected to do this entire calculation, and it'll only be worth 2 marks. Okay, so you need to be very quick at it. Okay, so that's the first part, 11 marks worth. After that, we have the second part, which says discuss the problems with the current system of calculating and reporting variances for assessing the performance of the production manager, and it's for 9 marks. So this is for the text that we didn't go through thoroughly when we were doing the first part, okay? And again, that's just to stress another thing. The calculation for variances, as you've seen, is usually just based on the numbers. There's no harm in going through the text, especially if there's some trick there, but the focus will mainly be on the numbers, right? So if you just see a number somewhere in the text, like we saw 4600 kg over here, read through that part before doing the calculation. But for the most part, you can leave the text most of the time. Okay, if you want to go through it to be safe, by all means. But for the analysis, yes, now we'll need to go through the text of the question. Okay, so now we're dealing with part B. And in the question requirement, it says discuss the problems. Okay, so we can't start talking about what's good about the current system. We need to talk about what's bad about the current system. Talking about good points will not get us marks, okay? What's the problem with the current system for calculating and reporting variances? So not just for the calculation of the variances, but also for the reporting of the variance and for assessing the performance of the production manager. So we have 3 elements we can cover it from. Okay, so let's just read through it again. So the first part is just fine. Kappa Co produces omega. It uses standard costing system to monitor its cost. Okay, but let's look at the notes. The mixing and heating process is subject to a standard evaporation process. Nothing much we can say over here. After that, it says alpha, beta, and gamma are agricultural products, and their quality and prices vary significantly from year to year. Okay, standard prices are set at the average market price over the last 5 years. So why the last 5 years, right? Especially given the high fluctuations, wouldn't that data become outdated very quickly? That's the point we could explore, okay? Kappa Co has a purchasing manager who is responsible for pricing and supplier contracts. Okay, let's be careful here, because this is something that we can very easily overlook. Purchasing manager, right? We usually just think manager and we think, okay, it's talking about the same manager, but look at it down below. It says production manager, okay? So there's 2 different managers in this question, and because production and purchasing both start with P, in haste we might easily overlook this fact, right? But that's a solid thing that we can possibly discuss, right? It says Kappa Co has a purchasing manager who is responsible for pricing and supplier contracts, yet we're talking about the performance assessment for the production manager, okay? So why is the production manager being assessed for something which the purchasing manager is responsible for? That's another point we can write, right? Okay, then it says the standard mix is set by the finance department. So again, the mix is determined by the finance department. Who do you think knows the best about the product mix? Is it going to be the purchasing manager, the finance department, or the production manager? Obviously the production manager. Why is the finance department doing it, right? And then it says the last time this was done was at the product launch, which was 5 years ago. It has not been changed since. Given that the quality and price vary so much from year to year, why hasn't it been changed for 5 years? So there's plenty of points we can write here, okay? Let's go through the last paragraph as well to see any points that could come up here. At the end of each month, the production manager, okay, now we're talking about the production manager, receives a standard cost operating statement, which is simply a statement which shows all of the variances collectively, right? From Kappa Co's performance manager. The statement contains material price and usage variance, labor rate and efficiency variance, overhead expenditure and efficiency variance for the previous month, which is fine. No commentary on the variances given, and the production manager receives no other feedback on the efficiency of the omega process. So we can highlight this fact easily, because remember, favorable variance does not necessarily mean everything is good for the business. It just means that you're doing good from a cost aspect, right? And adverse variance just means you're doing bad from a cost aspect. But for example, an adverse variance could be caused if you have higher quality materials which you're buying, which are more expensive. It'll cause an adverse variance, but they're higher quality materials. It'll also improve your quality, right? So we can analyze this from that aspect as well. It's for 9 marks. So I don't think there'll be 9 separate points of discussion, but each point that we discuss, like the 5-6 that we've covered, we'll elaborate a bit on them and we'll hit all those points and we'll get close to the full mark. Okay, so let's start. Okay, so it says discuss the problems with the current system with calculating and reporting. Let's start with the problems. Okay, let's just start with a brief introduction. The following problems can be considered in the current system of variance analysis. Okay, and then we'll start labeling the problems. Okay, problem number 1. So the first problem we got up here is that the standard prices of are set at the average market price over the last 5 years, even though the quality and price vary significantly from year to year. Okay, so the standard prices for the ingredients are set based on the average of the last 5 years. This is not sensible given the fact that prices vary significantly from year to year. 5-year-old prices will likely be outdated and would skew the actual numbers, right? It would be more reasonable to keep a shorter term time frame for calculating the variances. Okay, did we need to give this suggestion? No, not necessarily, because it's just asking us to discuss, but there's no harm in giving the suggestion. Unless you start overly focusing on the suggestion and not on the actual discussion, and that's another mistake students make. So they'll start saying they should do this, they should only use the average for last 3 years or something, and they'll just be focused on that point rather than the actual problem itself, right? So we need to make sure, even if we're giving a suggestion, we're focusing and highlighting the problem more than the suggestion, okay? Because that's what the examiner is looking for, okay? So after that, it says Capaco has a purchasing manager who is responsible for pricing and supplier contracts. So we'll say the purchasing manager is the one responsible for pricing and supplier contracts. If this is the case, then why is the production manager's performance being assessed based on variances such as materials price variance, which will be impacted by what the purchasing manager is doing, right? It is not fair to assess the production manager, and this is now the buzzword for something that is outside his control. Remember, planning operational variances, managers should always be assessed based on the controllability principle, based on what is under their control. That's a running theme throughout performance management. Okay, so we have 2 points. Let's go to the next part. It says the standard mix is set by the finance department. That's the problem. Okay, the standard mix is set by the finance department. This is problematic because the finance personnel are unlikely to be very familiar with the production process. It would be much more suitable that the production manager sets the standard mix, right? Okay, so number 4, Okay, number 4, the last time this was done was at the product launch, which was 5 years ago. It has not changed since, and as we know, the quality and price vary significantly, so there's an issue here. The last time the standard mix was set was at the product launch 5 years ago. Given the fact that the prices and quality of the ingredients varies significantly from year to year, this standard mix is completely outdated. It should be updated regularly. And we expand on this further. If the standard mix is outdated, it brings into question the accuracy of the usage, mix, and yield variances. Okay, so that's the 4th point. Okay, then we come to the last paragraph. So the statement contains material price, usage variances, labor rate and efficiency variances, and overhead expenditure and efficiency variances of the previous months, which is fine, but the usage variance could be possibly split into the mix and yield variances as well to give more detail. Okay, so point number 5. The standard cost operating statement contains the material usage variance, but not the mix and yield variances. These variances are very relevant to the production manager's role and would give a lot of insight. Ideally, they should also be included. Okay, after that, no commentary on the variances is given, and the production manager receives no other feedback, so that's bad too. So furthermore, there is no commentary given on the variances and no other feedback given. This is problematic because variances only cover matters from a quantitative cost aspect. They do not consider factors such as quality, which are critical in the making and selling of a product. This means that the feedback is very lackluster and missing on key areas which should be included. Okay, so we have 6 points. Again, it's for 9 marks, and we've covered pretty much all the main points, I believe, that we could have from the question itself. Now, should we add more points? Not necessarily, as in, like I said, these should easily get us about 7-8 marks because of the detail we went into, but we could potentially add more points by, for example, bringing the numbers in to some of our points if we wanted, just to highlight the shortcomings of the system. For example, the mix variance is very favorable, but the yield variance is adverse. Okay, so what does that basically mean? Basically, what it means is that the mix that we put in cost much less than the standard mix, but the yield that came out was much less than what we expected. So in the standard mix, we should have put in approximately a total of 5,530 kg to get what we got, the 4,600 kg. We instead put 5,620 kg. What these might indicate, given how large these variances are, is just that the standard mix is outdated, right? So we can put that in the fact in and highlight the fact that it's causing the yield variance to become adverse. So where was our standard mix point? Yeah, point number 3. So let's add some more points here. This is highlighted by the fact that the mix and yield variances are very large in opposite directions. Okay, and the current yield variance indicates that we are wasting ingredients due to the standard mix potentially being outdated. Okay, so that sort of further strengthens our point, right? But again, like I said, we've covered all the major points, so I think we're good to go. Okay, so yeah, that was a typical variance question. Once again, half the marks approximately for calculation, half for analysis. Like I said, please make sure to cover the analysis. It's honestly, if you struggle with variance calculations, these are the easy marks that you can get. Do not be intimidated. They're very easy marks. You're just explaining what's going on. Yes, you need a good conceptual understanding of variances, but again, we made 6 points here, right? You could easily, regardless of your level of understanding, hit most of the points, right? That obviously the purchasing manager and the production manager should be responsible only and assessed based on things which are under his control, right? That's just a standard point. Anyone could see that if the price and quality varies significantly from year to year, 5 years is too large a time frame, which is building 2 of our points, right? That the standard mix should not be set by the finance department because the production manager is responsible for the production. The finance team doesn't know about it, right? Most of these points could have been hit even without too much of a thorough understanding of variances, right? So again, focus on the analysis just as much on the calculations. Don't overdo it in either of the 2 parts, okay? So I hope this was beneficial for you guys, and I'll see you guys next time. Just one last point about this question, because I overlooked a major point which I should have discussed, and I felt it so important that I thought I'd make this update along with it. Okay, that is that in the statement there's no mention of the split between planning and operational variances, right? And that's a critical part of any variance analysis, which should not have been overlooked, right? So we can make a 7th point based on that, controllability based on planning and operational variances, right? And that's just a standard point you should always have in the back of your mind for such things, okay? So the standard cost operating statement does not split the variances into planning and operational variances, right? This does not give an idea of how the production manager performed with regards to things which were under his control and which were not under his control. This will be demotivating, that's a buzzword we can always use, for the production manager, as he could potentially be blamed for adverse variances caused by matters outside his control. Okay, so very important point. I failed to mention that during the original video, so that's why I've added this update, because it's that important. Okay, so please keep that point in mind as well.